Good evening, everybody. It is so great to be with you. My name is Scott Lurie. I am the founder of F Street. And tonight, I am so grateful for your time. We are going to discuss how to invest $500,000 with F Street. We use that placeholder number, but as you see in the lower corner, or any investment dollar that you choose to invest or consider investing. As an introduction, which we're going to do again in a minute, I just wanted to briefly touch on alternative investments and what that actually really means to a lot of people. People get very concerned or distracted with alternative investments, and we describe alternative investments as simply an alternate to the traditional stocks and bonds, mutual funds that we are all accustomed and have been trained to methodically and with discipline invest in. Alternative investments is a platform that's continuing to grow throughout the United States and our world. We focus on alternative investments, which we'll discuss. We focus on alternative investments only in the real estate industry. And so alternative investments shouldn't be scary. They should be something you should embrace. It's an opportunity to outpace the market, earn above market returns that we're comparing to traditional opportunities in the traditional stocks and bond markets. And as a result of that, we look at alternatives to the traditional ways to be an investor. So thank you for being here this evening. I'm really excited to run through our webinar. F Street, as I mentioned, is an alternative real estate investment firm. We focus on building long-term wealth and for our investors through passive and alternative investment opportunities. I always like to use this term, we are planting money trees. And when I was a kid, I always used to say to my parents, where does the money come from? And my mom would say, the money tree's out back. And I would always be find that to be great humor for us. But the reality is that we really truly are planting money trees. We are building Class A assets. We are developing unbelievable opportunities that truly should be lifelong money trees or opportunities for you. You make an investment today in 2024, and that money tree is going to do a lot of different things, include return your principal, which we'll discuss, provide you with a preferred return, which is a return on your money, and then it's going to also provide you with cash distributions throughout the life cycle of the investment. And for that, I call those money trees, and we do a lot of things to make sure the money tree grows and remains a great opportunity for you, the investor. So F Street, what is F Street? I'm going to share a little secret with you. F Street is a creative name I came up with. I attended the George Washington University in Washington, D.C. I lived on the corner of 22nd and F Street. And so I took the creative juices that I could extract out of my brain, and I came up with the name F Street. So a little joy of F Street. If you've ever been to DC, you've ever been into Foggy Bottom, you've ever been into the corner of 22nd and F, that's where F Street was created. A really fun, brings me back to my college days. I just had the joy and pleasure of dropping off my son this past weekend at the Indiana University in Bloomington, where he's attending his freshman year of college. And it was great to be back on a college campus. And so it brought back a lot of memories, but also one I wanted to just share with you briefly. So thanks for letting me do that. We're an alternative investment firm. We focus on three categories. As I told you, they're all in real estate. We focus on multifamily, we focus on industrial, and we focus on private debt. We're going to talk about all three of them. We're going to talk about three different platforms, how you can invest that $500,000 or whatever investment level you're comfortable with. We focus on just these three platforms. Okay, we're an alternative investment firm that focuses on real estate only in the industrial, multifamily, and private debt world. You're going to hear a lot more about private debt today, tomorrow, and in the future. Private debt is growing tremendously. It's an unbelievable opportunity to be part of, and we'll talk more about that as we get through the webinar. If you do have any questions or would like to ask anything, please don't be shy. The chat's available for you. We will be moderating the chat throughout the entire webinar. I will be respectful and mindful of your time. If you have any thoughts, please put them in there. If I can't answer them for you directly tonight, I promise you I will get back to you and answer them. If you're not comfortable putting the information in the chat, my email is scott@fstreet.com. Feel free to email me at any time. I talk to investors every day. I enjoy talking to our investors that are part of our growing business, and I'd love to speak to you as well. Don't be shy. It's your hard-earned money that you want to make sure you're investing in a prudent fashion to plant those money trees. A little bit about our team. Everyone likes to ask, or who's on your team. This is our F Street team. We are mighty. We are nimble. We are prudent. We're growing slowly and methodically. At some point, you'll get a chance to meet any of these folks if you would like to. But this is my team. I'm very proud of us, and we're continuing to grow and do amazing things. A little bit about our multifamily portfolio. Here's a couple portfolios that we're going to highlight. One is Tannery Falls, which is 71 units on the Sheboygan River in Sheboygan Falls. We're going to highlight Greenlink, which is a building that was just built, fully stabilized, and directly next to our property that we're about to be closing on across the street, which is F Street BD2 or Village 43, which we'll talk about. And then we've got Coast Apartments on the beautiful shores of Lake Michigan, 199 units of multifamily. We had one of our fastest lease-ups ever. We're almost 98% leased, and we've done that in about 8 months through winter conditions here in Wisconsin. The units on the right, some of our new townhomes we're building in Oak Creek, as well as some of our apartment conversions, hotel to apartment conversions that are there, as well as some some value add opportunities where we've acquired units. If you have any questions about any of these, let's jump into them. But just a little bit about our current portfolio. So we've got 1,155 units in our portfolio. We've got 2.1 million square feet of industrial in our portfolio and about 614,000 square feet of commercial in our portfolio. We are focused on this portfolio. We are growing in the multifamily and the industrial category significantly. We're really excited about what we've already done, but we're more excited about what we're doing. And we appreciate your consideration, obviously. One of the questions that people always ask is, what separates you from everyone else, right? We're not the only syndicator out there. And I can give you the simple answer is we're transparent and we're accessible. So if that means something to you, if you wake up in the morning and want to talk to Scott, Scott's going to speak to you. If you want to talk to one of the members of my team, we're going to speak to you. If you have a question about your investment, we have created a portal that's going to allow you to see your investment. We make monthly distributions, we make quarterly updates, we like to communicate, and we do a really good job doing all of that, and we're accessible. So if you don't like the way that GE stock CEO has made a decision, my guess is you're not going to be able to call him. But if you have a thought for me, I promise you I will answer my phone, I promise I'll talk to you, and I promise you we'll have a nice conversation. So, what was the thesis of today's webinar is how to invest $500,000 with F Street. We're going to walk through a few opportunities we have. It's great to be here, as I said. Investing is almost harder than earning the money. And what we find is a lot of investors don't take enough time to roll up their sleeves and contemplate what the future is for them or you or your family or your estate or your trust or your children. And it's really important to me that a lot of people go to work every day or to go to their careers or go to do whatever they do to earn money. And then when they come home, they're really accustomed to, well, it's in my 401k, in my IRA mutual fund, it's with somebody, I haven't checked in on them. I do an annual review with my stock advisor or whoever that might be. But I think you need to do more. I think you want to, the people that are doing more are really contemplating alternative investments. They're also contemplating tax shielding investments to continue to take more dollars and invest it. If you are paying a tremendous amount of tax, if you're a high net worth individual who's paying a tremendous amount of tax, there are ways through alternative investments to shelter that. If you spend a little bit of time learning about it, we can help you shelter tax with 100% within the code of the IRS that allows you to take advantage of this opportunity. And over 10 years, you might get $1 million or $2 million more of investable dollars. So it's real, it's meaningful, it's to me a requirement that you should really be considering, because if you spend 80 hours a week making all this money, and then during that same 80 hours a week, you're spending 35 or 40% of that same money on tax, well, you're spending not enough money figuring out ways to prudently avoid or reduce tax obligations. You're missing something. And so this is a really great opportunity. We love talking tax. We love talking opportunity. We love talking alternative investments. You're here tonight considering an investment with us, or learning more about F Street, or learning more about us. But for that, you should now take the next step and figure out all of the details around alternative investments or alternative investments to the stock market, figuring out a way to shelter and protect your tax burden so you can do more. All right. So how can you invest? Here's what I would do. I put $200,000 of the $500,000 in Village 43. Village 43 is also legally known as F Street BD2, which is located in Brown Deer, Wisconsin. We recently have completed, we'll call it BD, which is 134 units at Greenlink Apartments, which is directly across the street. We had a phenomenal result. We leased up. We're maintaining 95% occupancy in the property today. We've already done the building. We completed it on budget and on time, okay? Most important. How can you lose money? If you're over budget, that's a big problem. If you're not on time, that's a big problem. We will deliver Village 43 like we delivered Greenlink, on budget and on time. That is a huge risk mitigator, and we're really proud of that opportunity. Village 43 has demand for additional apartments in Brown Deer, and the Village has been so supportive of our success, and it's a great opportunity for you to invest. So I would put $200,000 of the $500,000 in Village 43. So what is Village 43, right? Village 43 is 156 units. We're calling it Village 43 of garden-style apartments in Brown Deer, Wisconsin. We are following our success of the building across the street that we already have proven works. The market works. There's demand for what we're doing. Greenlink is already stabilized at 95% occupancy, with 1/3 of the investors' capital already returned to them in 30 months and change. So we've built it, we've stabilized it, we've refinanced it, we've returned 1/3 of the investors' money. And every single month, today, every single month on the last business day of every month, Greenlink investors are receiving their money at distribution every month. We've never paused distributions. Distributions have always been going forward and will continue. We know that the market is strong. There's strong demand for housing in Brown Deer, which is very close to the Milwaukee market. There's great infrastructure. You can get from Brown Deer or Village 43 or from Greenlink, you can get downtown Milwaukee in 20 minutes. And one thing that's also pretty important to me is that we have a really, really strong relationship with the Village. The Village is providing us with incentives, which we're going to talk about, of almost $7.5 million that directly enhances our investors' yield. It is an unbelievable opportunity, and without a community supporting us, we can't deliver the returns that allow for a 24.64% IRR based on a 4-year hold. So let's talk about what our projected results are. We're projecting a 24.64% IRR. We have a yield to cost of 7.89% based on the projected year 1 NOI and incentive. And we're projecting a 1.96 multiplier on your investment based on a 4-year hold. So what does that mean, right? People always say, you throw out these crazy numbers, what does it mean? Well, let's just simplify this for everybody. For every $100,000 you invest in 4 years, you should expect to receive $196,000 back. So we should be able to beat the market. They say that you should be able to double your money every 7 years in the market. We intend to beat the market by 3 years. If you invested $500,000 in Village 43, you should be getting $980,000 back 4 years later. 1.96 equity multiplier. Your equity will double, almost, 1.96. Very simple way of thinking about it. So what is our business plan? What are you going to do? What is F Street going to do at Village 43? How does it work? So let me show you a little bit. Here's a great map. This is Greenlink right here, okay? This is Brown Deer Road. This is the major thoroughfare. And then Village 43 is directly across the street. That's actually it right there. This area right here. Okay? So it's directly across the street. It is a Class A development to design and build 156 units of market rate garden style apartments. Does everyone know what garden style apartments are? Most people don't, but they hear it all the time. Garden style apartments are simply apartments that are built that have your own egress in and out. They're above and below, so there's a unit below and there's a unit above, and people will enter through their garage space or through their front door into their own apartment. They don't have to walk through a corridor, they don't have to take an elevator, they don't have any other common amenity other than the door takes you into your own apartment. Our construction timeline is 8 months, 8 to 14 months. So if you see all of these various buildings that are in here, we're gonna start construction. We're gonna complete the first building in 8 months. So what does that mean? That we're gonna be able to start leasing the first building first, get some cash flow coming in while we're also continuing to finish the construction over the remaining 6 months. Pre-leasing will start in 6 months. So we're gonna close on this loan in September 4th. We're gonna be under construction, and 6 months later, we're gonna be pre-leasing for an 8-month later move-in. Pretty amazing. Now, the construction type is great. It's slab on grade, so we're building directly on the slab. There are no basements. We're building on concrete slabs, and we're going vertical, only 2 stories. We're about to complete a project in West Bend. We are doing phenomenal in West Bend right now, same style apartments. Construction schedule, on time, no problems. So then everyone says, well, what happens after that? Well, we plan to refinance execution, right? We're going to refinance the property. We're going to be going from our construction loan into some form of final refinancing, whether that's an agency, Fannie or Freddie, whether we decide to go with a local lender. We don't know exactly what will happen, but we are going to maximize the returns, which is the maximum amount of cash that we can return to our investors at the time of refinance, and then make sure that the cash flow of the units continue until the asset's sold. Then, and in addition to, we're going to have ongoing cash flow. Post-stabilization, F Street plans to distribute all free cash flow, 100% of the free cash flow. So think about this. Every single dollar that's coming into the project goes back to the investors until the investors receive 100% of their money. We're going to keep returning the money to you. So let's talk about our partners. Who's helping us here? So we have Green Fire, who is our general contractor. They are providing us with our contract to do the transaction, which is generally a GMP or gross maximum price contract. And the great news is Green Fire Management Services is an investor. They have put real dollars, they've wired them from their bank account into F Street BD2's bank account. They are fully invested in this transaction. We also work with Harmonic Residential. They're the management company that will be managing this asset. They also manage the asset across the street. And in addition, we have Rinka, who is our architect partner. Rinka has also invested in the project. Cash dollar investment, not deferment of fees, cash dollars. They have put their money where their mouth is, and they are make a material investment into this Village 43, 156 units apartment complex. So look at this beautiful picture. This is what it's going to look like. This is the garden style apartments that you see, lower and upper. Here's a door, you can go up, you can go into the first floor. We're building beautiful Class A, architecturally wowing, beautiful legacy asset. You want to own these assets in your estate, in your trust, in your family, in your world. You want to be an investor in these because they look good, they rent well, the occupancy stays high. This is what it looks like. We also do have a clubhouse, which is an amenity-rich part of what we say Class A elevated. So we are providing Class A elevated multifamily apartments. So, proven market. Everyone said, well, tell me more about what happened at GreenLink, right? So we have a white paper on GreenLink. Here's the white paper. GreenLink was a more complicated construction cycle, right? We had to build, and it was podium. So we have 4 floors of apartments. on slab with a parking structure. So we had a 16-month construction. We were 95% leased within 8 months of completion of that 16-month construction. So think about that. 16 months, 8 months after that, 24 months, we were 100%, 95% leased, okay? We paid 100% of the accrued preferred. In this deal, there was a 7% preferred accrued return, but this, and Village 43 is an 8% preferred return, but we've paid all of our investors, every dollar they put into the deal, they are earning 7% on their money. It's an older deal, but they earn 7% and we've paid 100% of the accrued preferred return. So what does it mean to accrue? During the construction cycle, during the part when we're building the building and we don't have income, we owe you money, but we need to accrue it because we don't have any way to pay it. So we accrue it as what we call the accrued preferred return. And then we have a 4-year post refinance payback. So after 4 years of that cycle, so let's do it together, 16-month build, 8 months stabilized, 4 years post refinance, all of the investors have 100% of their return. They have 100% of their money back, plus 100% of their preferred return. Pref, okay? What did we just build? We just planted the money tree, right? Here's the tree, because now you are going to continue to receive distributions from this asset until we dispose of it. And upon disposition, you're also going to receive distribution. So you're playing with 100% house money. Who's ever goes to the casino? I won $200, I put $100 back in my pocket, and now I'm playing with house money. You're playing with house money. 100% of your money's returned to you, 100% return. Your return, 100% of your preferred returns return. You have $0, you have $0 invested, $0 remaining, you continue to get paid. Great money tree. Make sense? If there's any questions, feel free to jump them in there. All right. So, prioritizing initial investment return. So let's talk about Village 43. Here's what happens with Village 43. You get an 8% preferred return. You put in $200,000. At the end of year 1, we owe you $16,000 plus your original investment. At the end of year 2, we owe you $32,000, 16 and 16. It doesn't accrue, it doesn't compound, but we owe you that until we start distributing the preferred return. The preferred return gets paid first. It's a preference. 100% of all free cash flow goes to the Class A members until your money's returned. We do not, at F Street, get $1 of cash flow until you, the investor, get all of your money back, every dollar, plus 100% of your preferred return. I'm so in line with the investors to get them all of their money back. Everyone gets involved in transactions, and I always ask people, when do you get your money back? 7 years, 8 years, 10 years. I don't even know. Some people are saying they're getting their money. They're not even getting their money back. Distributions are suspended. You are getting your money back. You can go take the money that you've invested in Village 43. You can take this $200,000 and plant another money tree. Imagine how fun it would be as if you planted money tree after money tree after money tree after money tree with the same money. How amazing would that be? Think about it. It's very, very unique. You get to keep planting money trees, and if you want to, you can wait till you get your money back from this deal and go plant another money tree. Some investors say, I'm going to do this every year for 3 years. It's a 3-year cycle, right? As you can see, it takes me 3 years to build, stabilize, refinance, starting the cash flow. But you can always get your money back. But if you made $200,000 investment this year, $200,000 investment next year, $200,000 a year after that, you have $600,000 invested. On that third year, you're going to start to see that first money tree is going to start paying out. Then you can take that money and plant another money tree. And in 10 years, if you do it every year for 10 years, you've got a lot of money trees. So, $200,000 gives you 1.72% of the ownership of the equity in the Class A. You get an 8% preferred return. Completed income. First building will be delivered in 8 months and monthly every month thereafter through 14 months. We plan to refinance and commence distributions Q3 2026. Quarterly ongoing cash flow. Quarterly ongoing cash flow. After you do this for 3 years, you're gonna be wowed at checks keep coming. We have investors that have invested with us for years. They keep getting checks. That's how it's supposed to be. Keep getting checks. Yes?
We had a question on how
Okay, so the question is, how do I get paid? How does the general partner get paid? So we, on our sources and uses, we earn a developer fee. That's a fee that basically keeps our engine running. And then after we return 100% of the cash flow to you, we get 40% of the cash flow and the sale proceeds once you have all your money back. So we get paid once you have 100% of your money back. We get 40% of the cash flow and 40% of the proceeds from a sale or refinance. So if I refinance and pull out $1 million, $600,000 of it goes to the investors, $400,000 of it would go to the GP. Question is this the same as a time equity model? I'm not 100% sure what you're referencing, but can you please reach out to me afterwards and we'll find time to talk. Peter, if you could put in my chat, my email, I'd like to speak to you about that. It probably is just a different way of saying what you're asking, and the answer might be yes, but I don't want to give you that answer without having a time to have that discussion. So the question is this one eligible for 1031 exchanges? The answer is it is not. We do work with families, family offices that are trying to that are placing or selling assets for 1031s. If you have a 1031, we do specialize in it. We do about 3 to 4 a year with families. We do ground up. You can do ground up, and it's a little bit more complicated due to it's called a reverse exchange. We can do it. We're actually doing one right now. So the answer is this one is not eligible for a 1031 exchange, but if you have one, let's talk. We have a solution for you as well. So we talk about a sensitivity analysis, right? So people ask all of the time, which are great questions. What happens if your scenarios and what are you making your assumptions based on, etc. Okay, so here's what those are. Is we've taken the information, which is your investor cash flow. It shows how we calculate the $200,000 invested, gets you the 1.96 multiplier, which is right here. And then we have made the assumption of the various different cap rates to percentages, which is the refinance rate of the interest and the exit cap rates that run around there. And we get to these various different components. This is all sensitivity. So someone says, well, what would it be like if interest rates were 7% and your cap rate was 7%? Well, we would have a bleak 14% return, right? That would be bad. So we model this at what we think market is. We do make a lot of assumptions along the way. We do feel really comfortable that we will be able to exit at the 5.5% interest rate. Right now, we can get that in the CMBS, Fannie, Freddie markets. So we're very comfortable there. But these are our assumptions. This is what the modeling looks like, the sensitivity looks like. Feel free to ask any questions about it. But we've put a spectrum out there of what it might look like and what if we do better, what if we do worse, where does it land? We're really comfortable with, based on our experience and based on what we know in the market, where we're going to get and how we're going to exit and produce the returns we've already illustrated. So the question, I think, is, thank you for the question, when is the investor equity taken out? It's a great question. Never. Once you invest in the deal, why should you ever be taken out of the deal? There's no good reason. No one has a good reason. You've made the initial investment. You've put in the pain with us. You're part of the startup. You're accrued your preferred return. Your equity, what you buy in on today, what you put in the deal today, is in the deal until we sell the asset and the asset is disposed of. That's the only time that it goes away. It never goes away. We don't have the right to buy it back. We never discount it and buy it back from you. We never reduce your returns. All of that is garbage. So if you're contemplating that with someone else, please stay away from that. Once you've made your investment, we are so thankful for your investment. Your investment's your investment. Now, at the same time, it's an illiquid investment. You can't go and sell it tomorrow on a commodities exchange or any other market. It's an illiquid investment, but it's an investment. So plan ahead, be mindful, spend the extra time you're doing right now of your due diligence. You always are our partner. You always own your equity. Great question. Yep, so the capital stack and the debt structure we can absolutely discuss. We have a thanks for leading in, whoever did that for me. Thank you. We've got a $26 million loan, a first loan from First American Bank. It's at 70% loan to cost. The additional cost, the additional 30% is coming from equity from ourselves and our investors. We have a 36-month term on the first loan with we have a 36-month term with 2 one-year options to extend. Right now it's at SOFR plus 295, and it's interest only during the entire term. So there's a lot happening here. First American Bank has been an unbelievable partner of ours, and we're really excited to work with them on this deal. Yep. So taxes. The question is, how are taxes handled with an IRA investment? We do issue K1s. You are a partner under this transaction. We will issue a K1 issued out. If you do have a 401k, IRA, self-directed IRA, any of the deferments, you will follow the laws underneath those guidelines. You won't be able to get the benefit of the depreciation. So we will do a cost segregation study on the new building, or a 179D, which will happen on the new construction. And you won't, if you invest through one of those channels, you most likely will not be able to receive the benefits of the depreciation, but please check with your tax advisor. The question is, and it's a great question, how many capital calls have we made? 0. We've never made a capital call. We are very proud of that answer. That's one of the things that we work really hard at here. We're sophisticated. We make sure that we never have to be in a scenario where I have to issue a capital call to an investor for something, right? And what is that something? Well, the something is traditionally would be an overrun on the construction of the GMP, unknown under the getting out of the ground or part of the construction related. You would have a bad loan that would require a pay down at some point during the cycle. There's a magnitude of reasons when those issues would potentially rear their ugly head. We have never, ever, ever issued a capital call. Okay, so wrapping up Village 43, as I mentioned, we do have a TIF incentive. We almost have $7.5 million, payable over 21 years to the project. Now, the Village is providing us with tax incremental financing, TIF, for this project of almost $7.5 million. That goes to enhance all the investors. That means that we're not paying tax on the project, essentially, for the period of 21 years. It's a little more complicated than that because it's not 100% abatement. There is some form of tax. It's very minuscule. But the reality is that we receive $7.445 million of value to the project. The nice thing is, which is very important, is that it runs with the project. So if we sell the project in 10 years, a buyer still will have 11 years. When we go to market it, they'll still have 11 years of TIF, which is super valuable to the buyer. So the question is the tax benefit included in the IRR of 24? The tax benefit of the depreciation is not. The TIF, this TIF piece is contemplated, yes, absolutely, in the in the IRR calculation. The depreciation or the other side of it, it's not, but this is. All right, so we went through Village 43. We're closing on it soon. We've raised almost 95% of the dollars. We've got room, but we'd love to get you in. It's heavy lift for us right now to get to the closing, which is happening in the first week of September. We're already ready to break ground in construction. We're very confident in the deal. We had some long lead items. We've already put a notice to proceed on those. The site's been leveled. We're prepping. We're ready to get going. So think about BD2. The nice part about an investment, and I mean this sincerely, is you get to, if you invest in BD2, your money's going to work tomorrow. Meaning we're closing on it, we're building on it, it's happening. You're in the cycle, you're gonna get a K1 at the end of the year. There's a lot of good stuff happening. So get involved. The other opportunity, put $150,000 in Summit. Summit is F Street OCLV MF2. It's in Oak Creek, Wisconsin on the beautiful shores of Lake Michigan. We've already had proven commodity here. The risk has already been mitigated. I've already built 199 apartment units here. They're already 93.5% leased. We're having a tremendous amount of pent-up demand in the market for people wanting to live there. We've given very little, if any, concessions away. The place is doing amazing. Summit. Summit is coming on the heels, which will be 74 units of market rate apartments. We're projecting an IRR of 20.48 on a 7-year hold. Time frame's different, 4 years, 7 years. Coast Apartment success. The Coast Apartments, which is directly across the street, are 6 months ahead of schedule with cash flow to investors beginning in Q3. Just 18 months on 199 units of build. We are going to commence distributions next quarter. I'm so proud of that. I hear all of the horror stories of all of the craziness that's going on out in the world. People didn't project for interest rates. People didn't project for lease up. People didn't project for rising interest rates. People that are in bad loans. We are starting distributions. Think about it. We are starting distributions. We also have that strong relationship. You'll hear this a lot about in all of our F Street deals, but we really try to partner with these municipalities. They need housing, we want to build housing, we want to deliver quality housing, Class A elevated, and we knock it out of the park. So the business plan, Class A development, we're going to build 74 units of Class A mid-rise apartments on the south building in Oak Creek. Construction's a 12-month timeline for the first units to be delivered after 12 months. Pre-leasing will start 6 months. We're going to do that strategic refinance we talked about in Village 43, and then the ongoing cash flow, monthly or quarterly distributions after stabilization to the investors until they're repaid. Here's the site map. Coast is what I'm referencing. That's already built. 199 units, we're done. We're at 93.5% occupancy. Ivy, which is over here, is already under construction. We're at 18.8% pre-leased as of last week, and we're delivering our first buildings 1 month early. Oh, and on budget. Summit is going right here. Here we go. Beautiful building. All of this over here is amenities. This is all amenities. This is a park. Here's the clubhouse. Here's the tennis courts, the pickleball courts, the basketball courts. Everything's here for you. It's a perfect dream place to live. So the projected IRR, 19.12 based on a 4-year hold. Refinance after year 2. We're at 7.74% project based on a 1-year NOI and incentive. That includes the incentive we're going to discuss. And based on a 4-year hold, we're at a 1.78 equity multiplier. Invest $500,000, bring in $890 just 4 years later. Partners. Stevens Construction, helping us. They're going to be our GC. They've invested in the project. Harmonic will be managing the asset for us. Rinka will be our architect. Rinka most likely will be investing in the project as well. Here's what this beautiful building is going to look like. Amenity rich, architectural, great eye for architecture, well-received, common area amenities, strong demand to live longer at the lake. Project partnership. Lakeshore Commons is a collaborative effort to repurpose this brownfield. We have a deal with the city of Oak Creek. So what's the deal? The city's also spent all of the money to get the site to be completely cleaned. Then they've provided us with a horizontal infrastructure with $30 million total, but $17 million has already gone into phase one, which is benefiting this summit. Then we have a vertical TIF of $3.69 million over the next 19 years for these units. And Andrew Vickers has been a great supporter, but he's the city administrator for the city of Oak Creek. This is going to be another unbelievable asset to have in your money tree. So the question is, why do these projects qualify for TIF, and is it because they're rent controlled? So the answer is it has nothing to do with rent control. There is no rent control in the state of Wisconsin for market rate apartments, meaning we are not receiving government HUD. So Wisconsin has a HUD department that issues out dollars. WEDA, Wisconsin Housing Economic Development Association, gives out dollars that has limitations. These are market rate apartments. We can list these for rent for $3 million a month, and if someone chose to pay it, so be it. This has nothing to do with rent control. These are not rent controlled. They have nothing to do with, and no one tells F Street or Harmonic what to rent them for. We can rent them for whatever we want. The subsidy TIF was created for the but for, right? So but for something, we would not be able to. So the cost is really the but for. So we get this incentive. It's kind of a cycle of events that happen, but we have construction costs, or we have to put in infrastructure, or there's something else there that's causing us that the deal, but for a TIF, we would not be able to make it economically feasible. And so that's what this means. And it basically allows for movement on a sources and uses of capital so that we can make them, whether you say investment grade or not investment grade or feasible or non-feasible, we look at it as we have to make it feasible, and that circle is feasible, bankable, financeable, equity investor, right? So it needs everybody in the cycle, and so it really has to do with that cycle versus anything else. Okay, a 15-minute warning. Harmonic is a management company. They're a conglomerate of local different folks that have spun off from what was Colliers International locally. They used to manage Colliers International still manages commercial buildings. Harmonic is their residential arm. Some of their partners invest in deals and have the right to. Harmonic just is not set up as an investment house. We include them as partners, and they have offerings to their investors, meaning their owners, but as an entity, they don't invest. Stevens invests as an entity, for example. So, if that makes sense. Okay, so TIF, we already talked about it. We have $3.679 million under this particular investment over 19 years. The benefit is obviously transferring to future ownerships. They all stay with the development. So where else will we put some money? Well, VAM Fund. VAM Fund is a value-add multifamily fund in Chicago, Illinois. We would make a $50,000 investment, if you were asking my opinion of it, into the VAM Fund. These are existing buildings located in Chicago, right? So these are multifamily deals that there's still tremendous demand for housing in Chicagoland. This would be a 20% IRR over 6-year hold. We are in partnership with Chico or CKO, and we're basically buying and renovating multifamily distressed assets that were part of a portfolio of distressed assets due to some improper management of apartments. So Chico owns tons of apartments in the area. We're adding to that portfolio, and there's an opportunity to invest in the value add. The nice part is I don't have to build these. They're already built. So you would get a 2.02 times multiplier after a 6-year hold. We are buying 151 units, which comprise of these addresses right here. Those are the 151 units. Total equity raise is $6.5 million, and the stabilized value per unit is about $179. So walking through this, once again, it's an 8% preferred return, 100% of the cash flow. You'll see the theme, 100% of the cash flow goes back to the investors. Once that happens, 50% goes to the Class A, 50% stay with the GP. We're targeting 75 to 90% of the capital return to you within 3 years. So this money tree has a chance to blossom much faster, meaning your money's going to be back to you much faster. But we intend to have all of it back to you within 5 years. How do we do that? We're increasing NOI. It happens at a much faster pace. We don't have to build the buildings. We just have to renovate the units and get the units stabilized, get the buildings refinanced, start the cycle. That's why it happens a little bit faster in this scenario. Okay, so we talked about a 20.68% IRR on those deals, a 2.02 times multiplier based on a 6-year hold with the refinance happening in 2 years. If you invested $500,000, you could get back $1.01 million 6 years later. And then the namesake, not really because there's no name in it, but this was our first ever fund that we created, our private debt fund. This is the private debt fund that I'm so proud of. I started this in 2009 with $700,000 from mom and dad and my college roommate who lived with me on F Street and his buddy, and I got $700,000. We almost have $100 million in this fund today. 100 million. It's a private debt fund. You're going to hear about private debt for the rest of your life now that you heard it here today. So hopefully your Instagram wasn't listening to it, but private debt is where the world is going. Let's talk about the private debt fund. High yield private debt fund. We pay 10% return. It's so simple. I made it up. I graduated from the George Washington University. I came up with this very simple algorithm. Here it is. You put in $100,000. I pay you 1/12 of 10% every single month. I've been paying it out for almost 16 years. Every single month, I distribute 1/12 of 10% on your investment. My first investor put in $50,000. They've got $3.5 million with me today. They're getting $350,000 a year on their money. So how do we do it? I make investments in other people's investment. I lend money to other real estate investors and I charge them 15%. We catch the spread, we make the profit. You want to invest with people that are profitable. I say this maybe ad nauseum, but if your business isn't profitable, if we're not making money, at some point I'm not going to be able to pay you. Every single month we make money. You want us profitable. We are profitable. We distribute money to you every single month. If anybody is in the private debt fund that's listening to this, please confirm that they've received money from us every single month. We always pay. Last business day of every month, we pay. If you invest today, you will get your first distribution check August 31st. It happens. I promise you. I can't guarantee anything because that's a bad word, but I promise you it happens. It's happened for the last 15 plus years. How it works. Make a $100,000 investment. You receive $833.33 every month or $10,000 a year. We distribute to you via our portal a 1099-T at the end of the day. I just got I'm sorry I'm going to be running out of time, but I want to tell you, we just got the greatest review from one of our investors that posted on Google for us that I'd love to share with you. But it was an unbelievable review where this individual came to us. He wanted to make a material investment, 7 figures. He invested with us. And I'm so proud of the review because it made my team all feel great and me feel great. This is the reason we built this business. Provide above market returns to investors. It's amazing. Pete, I don't know if we can put that in the chat. I'd love to share it with them. Okay, once your money is in, it's tied up for 12 months, okay? That's it, not 20 years, not 5 years. If you want your money back after 12 months, tell me. And please give me 90-day notice. That's all I'm asking for. You want your money back, let me know. If you need your money back, let me know. We have over a 95% retention rate. It's because I am consistent. F Street's private debt fund pays 1/12 of 10%, 10% a year. It pays. Have I ever stopped distributions? No, never. Have I ever missed a payment? Absolutely not. So, Albert Einstein, compounding interest is the eighth wonder of the world. He intrigued me to figure out how to get compounding interest to work at F Street. And we just released this 2.5 months ago. So here's what compounding interest looks like. I encourage you to consider it. It's at your discretion. If you want to check every month, I'll pay it to you. If you want to compound it, I'll compound it. If you want to do a hybrid 50-50, 60-40, 70-30, you pick, we'll make it happen. But we now have the ability to offer a new compounding interest option. Your money gets to earn money and earn money. Amazing. This is just a chart pulled out so you can understand what happens if you're paid monthly versus what happens if you compound. So, fund benefits, consistent payout. F Street has never missed a payment in 15 plus years. I have never missed a payment. I have references and referrals to assure you that. Call them, talk to them, do your due diligence, please. We'll give you names and numbers, call them, ask them questions about us. Please do so. We continue to have tons of demand for our product. We're receiving 300 plus applications every single month from borrowers who want to borrow money from our private debt fund, so we're deploying your capital. If you're looking stability and liquidity for investors looking to avoid long market wait times and seeking immediate returns, put the money in today, you'll get your first distribution August 31st. We provide monthly returns, delivers returns cash flow monthly. If your lifestyle costs you $10,000, some people go backwards. I need $10,000 a month, $120,000 a year, I'm going to invest $1.2 million. That happens all the time. Here's what we paid. In 2023, $4.21 million to our investors. Be part of it. So, as we're wrapping up, I want to open up for a few other questions. I just want to kind of show you, this is your dashboard, right? What is our dashboard? We spend a lot of time perfecting the technology side of our business, right? When you wake up in the middle of the night and you say, where is my F Street portfolio? It's right here. Here it is. You want to look at your portfolio? Look at it. You have questions? They're there. You want to know where your money's invested? It's showing you. It's showing you how much you've received from investments, what's your total distribution, how much capital have you returned, what's your return on the capital, any updates, any K1s, any subscription agreements. All of the information is housed in your secure portal. This is yours. You can add to new investments. You can request documents, you can request anything. But here's the one request you have to do on your own. Schedule a call if you'd like to talk to us. You want to talk to me, I'm happy to talk to you. You want to talk to Mitch or Brian or anyone from our investor relations team, they'll talk to you too. We want to talk to you. We want to educate you. We want to help you understand the options that are available for you. And we do hope you invest. If you choose not to, that's up to you. But we do want to talk to you. Make this your dashboard. We'd love to get you involved. Any questions? Yep, great question. So the question is, what are we investing in? Are we investing in the first position? The answer is we only invest in the first lien or the first mortgage position on every single loan that we do. We have 585 active loans. We are only the first lien position on every one. We only lend up to 65% of the after repaired value. That's it, 65% of the ARV. So we empower other investors who are fixing and flipping or building a rental portfolio to do acquisitions with us. And I encourage you to visit the Hard Money Co., which is the brand. Look at our Google reviews. You'll see all of the customers that are happy customers, and I think one that's not, but you'll see all of those in place. So the question is, what's the exit strategy for VAM? The exit strategy for VAM is, the first one is a refinance. So we intend to refinance and repay the capital back to the investors. We have contemplated a 6-year hold, to which would be a future disposition of total sale. But most important to us is that we're going to get all of the investors their money back in 5 years, with a 3-year goal of trying to get back 75 to 95% of those funds. So we have 2 different benchmarks. The initial is the refinance, drive the value, get the investors their funds back, then contemplate a disposition at year 6. So the question is, what is the default rate on the properties? The default rate ranges, and it ranges every single month. What I think is important to understand that is people can go into non-payment status, and that happens anywhere from 4 to 8% of the time. But as long as they're communicating with us, most of those entrepreneurs work their way out of it. We take back as an REO where someone actually doesn't complete the transaction 1 to 2% of the total loans in a year in any given one time. So default is relatively low for the risk, but at the end of the day, every single month we're profitable and we're driving returns. So we do experience default. That's part of the business we're in, is writing loans. People do not choose to not pay. We encourage them to pay, but when they don't, we have an REO asset manager. We have a team that's in place to handle the property, taking it back, and then the disposition of the property. So the question Ross asked, thank you, Ross, is do we trickle distributions, payments for repairs, or do we give it to them all at closing? The answer is we do about 110 repair escrow distributions a month. So we have a very, very sophisticated process. The process starts at the loan application. When we receive a loan application, the borrowers provide us with what we call a scope of work. That scope of work then goes into their file. When they want to go to our website, thehardmoneyco.com, and they say they want to do a repair draw, they match the scope of work we received at the beginning for the repairs they're asking for. Let's just say it's a roof. So they had an $8,000 item for a roof repair or replacement. That's on their scope of work. We match it. We then send them a GPS sensitive link, which requires them to send us pictures directly from the address, with no delta of distance of geography. You have to be right at the address, and we require them to send us pictures. Once we get those pictures, we make the distributions back to them within 24 hours. So there's a lot happening there, but it's important we match up the scope of work to make sure the work's getting done. And then further, we want to make sure that we get them their money as fast as possible to keep the entrepreneur on track. Sure. So the fund is diversified across all 585 loans. If you invest today, you're diversified across the portfolio. So you're not tied to any one loan, and I always encourage people to understand what that really means. The benefit of that is you are truly diversified across everything. So if somebody defaults, you'll never know. Distributions will continue. Distributions have never stopped. We had our 5th best month ever in July 2024, last month. There's a lot happening. The private debt fund is amazing. I encourage you, if it's your starter or if you're looking for additional cash flow, it's a great place to consider. So the question is, when does accrual begin? I think your question is, when does the accrued preferred return begin in the multifamily investment that you'd be making? The private debt fund doesn't accrue, it just pays. So there is no accrual. The answer is on the day that we close on the loan. So if you put in the money committed today, let's just say September 4th is our closing date. That's the day that the accrual would begin. Yeah, so the question, it's a great question. How would I diversify beyond F Street or the multifamily? Well, so I would take multifamily, I would take our private debt fund, I would take our industrial fund as 3 great diversification plays across F Street's portfolio. There's also a lot of other great opportunities that are out there. I invest with other private equity funds that are doing very interesting things in private equity, but I'm not a cowboy, right? So I don't want to go and pioneer. Venture is not really for me. I do very, very little side investing in venture. It's too hard, right? You need to pick a needle in the haystack, and the reality for me is I don't have the time to invest in the needle in the haystack. So we invest in private equity funds that are buying real businesses that need additional growth capital, that are then going to look for an exit in 1, 3, 5, 7 years, and we play that game. Diversification is really important. I'll tell you this, I'd love to have every dollar that you have to invest with F Street, and there are people that invest every dollar with us. There are also people that diversify. I get it. I'm a preacher of diversification. I diversify myself from my own self, right? I invest with other people because it's good diversification. So there's ways to do it. There's other really good sponsors. There's other really bad sponsors. There's sponsors that are out there telling you these funds are going to pay you 12 and 15%. The question is how? At the end of the day, ask that question to themselves. Ask them their business plan. How the heck are you going to pay me these numbers? The reality is they're not. We've seen, unfortunately, just saw one private debt fund just stop distributions and it went away because it was fraudulent, but it's been in existence for a little period of time. So, I always tell people, do your due diligence, right? Don't just invest 100 grand because it's 100 grand. 100 grand, if you don't want it, give it to a charity. If you just don't think 100 grand's worth enough, make a material investment to a charity. If you want to make a material investment to your future and your investment, ask a few questions. See if you can set up a lunch. Meet with the people. Do a video call if you're not local. Ask for references and referrals. Those are my best calls. Hey, can I have a reference and referral? Here's a list of 20. Call them. And then they call them, and that's great. Oh, I just spoke to John Smith. He said great things about you. Thank you, Mr. Smith, and thank you for Mr. Investor Potential for making that call. You have to do your due diligence. You have to understand. We are transparent. We are open to any questions and discussions. We are right here in Milwaukee, Wisconsin. If you are nearby, come to my office. Let's talk. We have investors stop by here every day. They live within a couple, 100 miles. They stop by. I want to meet you. Great. I want to buy you lunch. And I will buy you lunch. I love lunch. So I hope that helps. Is there one more? Take that one and then, okay, we've got a few more questions that I didn't get to, and I want to be respectful of your time. There's one question that says, are you concerned about the fund getting too big and deploying capital basically frivolously? The answer is absolutely not. We have a policy here where there is no one is compensated on distributing out funds fast, rapidly. There is no bonus structure that encourages them to be undermine the process. Absolutely not. We do have goals of growing the business to $200 and $300 million. That will happen in 18, 24, 36, 55, 4 months. I don't know. We're going to keep growing the business, right? We love the business. We see it growing. We've got a great widget. We're continuing to grow it. The answer is no, and it's a great question. We have a bunch of questions that I didn't get to answer. It's past 7 o'clock. I told you I want to be respectful of your time, and I want to be respectful of your time. I really enjoyed our conversation tonight. I'm going to take those comments, those questions. If you didn't get your question asked, it's scott@fstreet.com, or Peter and I will go through those and we'll make sure we get back to you. scott@fstreet.com. Feel free to reach out to me. I'd love to talk to you. This is your hard-earned dollars. You're contemplating investing with me, and I'm very respectful of that. I want to give you the time that you deserve, and so I thank you for that. I want to also, as I said, be respectful of your time, so I want to wish everyone a wonderful evening. I want to thank you for participating this evening. If you have friends that you are interested in learning more about us, we can do group calls or whatever discussions you want. Once again, my name is Scott Lurie with F Street, scott@fstreet.com. I want to thank you for your time, and I hope you have a wonderful evening. Thank you for being part of our webinar this evening. I hope to see you all very soon.